In this lesson, the topic we will talk about is a cash flow statement analysis for lawyers. Cash flow statement analysis is a powerful tool for lawyers, enabling them to uncover financial realities, trace assets, and build compelling legal arguments in cases ranging from bankruptcy and divorce to fraud and business valuation. Mastery of cash flow interpretation is essential for effective advocacy and due diligence in legal practice. A cash flow statement outlines a business's cash inflows and outflows across three key sections: operating activities, covering cash from core operations like customer receipts and supplier payments, crucial for assessing viability and solvency; investing activities, detailing cash from buying or selling assets, relevant for asset tracing, valuation, and fraud detection; and financing activities, showing cash from loans, stock issuance, debt repayment, or dividends, important for analyzing capital structure and shareholder disputes. Key items include net cash from operations, depreciation, working capital changes, CapEx, asset sales, debt equity transactions, and cash balances for comprehensive legal analysis. Practical tip: the cash flow statement focuses on actual cash movements, making it more reliable for legal analysis than the income statement, which can be manipulated by accrual accounting, or the balance sheet, which is a snapshot in time. Cash flow analysis is crucial in several legal scenarios. In bankruptcy proceedings, it helps assess solvency, sustainability, and the need for liquidation, with a focus on operating cash flow and unexplained inflows, see outflows. Red flags include persistent negative cash flow or sudden changes. In divorce settlements, cash flow reveals true income, uncovers hidden assets, and assesses lifestyle by distinguishing personal versus business cash flow and tracing funds. Red flags include unexplained transfers or lifestyle income mismatches. In contract disputes, it evaluates performance ability and calculates damages, focusing on historical cash flows and inflow-outflow timing, with red flags like manipulated timing or inconsistent reporting. Cash flow analysis is vital in various legal contexts. In fraud investigations, it helps trace misappropriated funds and detect embezzlement by focusing on unusual cash movements and mismatches with other statements. Red flags include large or unexplained transfers and round-dollar transactions. In business valuations, it supports or challenges valuations in mergers, disputes, or estate matters, with a focus on free cash flow and historical versus projected trends. Red flags include overly optimistic projections and inconsistent trends. Across cases like bankruptcy, divorce, or contract disputes, key aspects include operating cash flow, fund tracing, and performance capacity, with common red flags such as hidden transfers or manipulated cash flow timing. In a divorce case involving a business valuation dispute, one expert applied sales multiples while another used normalized cash flows, adjusting for factors like market rate rent and owner compensation. The normalized cash flow method was favored by the court as it more accurately reflected the business's economic reality and distributable cash, providing a clearer basis for equitable distribution. This case highlights the importance of cash flow analysis in uncovering true business value in legal disputes. In a fraud case involving misappropriated funds, experts employed tracing methodologies such as FIFO, LIFO, and LIBOR to reconstruct cash flows and present alternative scenarios of fund movement. The court's decision relied heavily on the clarity and credibility of the cash flow tracing analysis, which helped identify the flow and misuse of funds. This case underscores the critical role of detailed cash flow reconstruction in uncovering fraudulent activity and supporting legal outcomes. In the case of Sec v. Baker, involving executive compensation recapture due to misstated financials, experts analyzed cash flow discrepancies to assess their materiality to investors. The court upheld the recapture, concluding that the misstated cash flows were significant enough to impact investor decisions. This case highlights the importance of accurate cash flow reporting in securities law and its material relevance to financial transparency and accountability. Using cash flow evidence in legal proceedings requires a strategic approach. Start with a broad analysis, then drill down to transaction-level details, classifying flows into operating, investing, and financing activities. Contextualize findings using industry benchmarks and historical data, and present them with clear charts or tables for clarity. Reports should be logical, concise, and fully transparent, with disclosed methodologies and reconciled figures to match source documents and other financial statements. Using cash flow evidence effectively in legal cases requires narrative framing, highlighting discrepancies, quantifying damages, and tracing funds. Qualified forensic accountants should explain analyses clearly. Avoid overcomplication, poor documentation, and inconsistent methods. To sum up, cash flow statements are vital in legal cases from bankruptcy to fraud.